Good afternoon, and today's session is, well, it looks really long, like ordinary shares, preference shares, dividends, and retained earnings. The thing is, if I try to take just, they are connected, but if I try to take just one at a time, I'll be dragging it too much. So whatever I'm able to do today, we'll stop there. So if I'm lucky that I'm able to touch on everything equally, great. And if it is that, I stop at dividends, then great. What will be a problem is for me to give a topic, then by 10:30, I mean like 30 minutes into I'm done, and then you're like, and I start dragging what I've said. So that's why I made it really long. So I am going to move in right now so that we don't waste any more time. Everything on about the shares, dividends, and retained earnings in the financial model, they are in the equity schedule. So I will show us how that is being the structure for it. But first of all, let's go a bit more into the theory, understanding all of these, at least concept-wise, and knowing what the differences are before we start talking about the numbers. So what I've done is, okay, first of all, a small advert. These are the trainings we have coming up in case you know someone who needs a training, or someone who, you can even be you who maybe one of these trainings are relevant to you. So you can always reach us. You can go to www.UrBizEdge.com, Lagos, Abuja, Port Harcourt. Okay, so types of shares. So let's start first with the theory. Many of us do not know that there is many types of shares. To be sincere, before I started preparing for this stuff, if you had asked me what are the types of shares, I will tell you ordinary shares and preference shares. And then if you kind of dig deeper, you keep telling me I should give more, that there are more than two. I will say, okay, ordinary shares, there are different classes. Some companies can do class A, class B. 2 classes are common, but some can have 3 classes. And then preference shares, I'll be like, preference shares, there's convertible, non-convertible. But as you can see here, there are many permutations. So I'm going to go from beginning to end. Okay. And so let's start with the ordinary shares. So for ordinary shares, kind of very straightforward. If you incorporate a company, so you as the founder of a company, you will have to incorporate the ordinary shares. So that's like the de facto ownership shares, kind of. So people who are starting a company must always issue ordinary shares. There can't be a company that does not have ordinary shares. There can be a company that does not have preference shares, but you cannot not have ordinary shares. Okay, so for ordinary shares, there are three types. Let me quickly modify this. There are actually 3. So there's let me call it the normal ordinary shares. Okay, then let me just use the opportunity to move this up, make this bold. Good. Apologies for that. So there's if you have any question, you can chime in and let me know. So there's the normal ordinary shares. If you incorporate a company, that's what it is. I've incorporated a company here in Nigeria, and that's even your lawyer sometimes might not know, depending on the kind of lawyer you're using. If it's a lawyer that is just, has not been exposed to the other type of shares, everybody, the only thing they will ask you will be 2 things. Okay, how many of you, and how are you sharing it? Then how many shares are you issuing? Those are the things they will just ask you. They will not tell you to start giving them, will they be voting rights? They won't ask you most of those things. Why? They are not common. So a lawyer that's not, has not experienced all these different types, will probably not even know they exist. Okay. And when you're incorporating a company, you have to go through a lawyer. I think now maybe you can do it online. For Nigeria, I know it used to be a lawyer. So the one that gets done for you is the ordinary shares. I mean, the normal ordinary shares. You have voting rights shared by the number of people that are coming together to form the company. So let's go to the number 2. So the number 2, which is the non-voting shares, okay? So for the non-voting shares, it's like an extra clause. It's like something that you have to bake in beyond the ordinary template. So if you are incorporating a company, if you don't tell them any of these, it will be the normal ordinary shares the lawyer will. That's the template they have. They have a template that's what they just kind of follow for everybody who comes to them, except someone who maybe tries to ask you more questions. So when it's going to be a non-voting shares, it has to be baked into it that, okay, these shares are non-voting shares. So the next question is, why will a company want to issue a share and make it non-voting shares? Anybody wants to chime in? Why do you think a company will want to have a category of shares that do not carry any voting rights? Anyone want to take a guess? Oh yeah, let's make this a bit more interactive. Why? Just think about it. You have a company, you started it yourself, and why will you consider trying to have some shares that you will give some people? Let me use that word, because like I said, when you start a company, you must always have ordinary shares. So usually as a founder, your ordinary shares will be the normal ordinary shares. So then why would you want to have another class of shares where you will make it in the clause as non-voting shares? Anyone? Going one? Let me see if anybody's on. Okay. Yeah, I see a comment, but yeah, someone wants to say something. Yeah, okay. Let me start with Mr. Glory. I see your hand up, sir. Yes. Mr. Glory, yes, you can unmute and okay. Maybe he doesn't know his hand is up. Mr. ID. Okay. Let's see.
Okay.
Yes.
Sorry, Mr. Maki.
Okay.
It's my device that was giving me challenge on muting the device.
Oh, okay.
A company may want to do that. I think a company will want to do that to issue a non-voting shares because they don't want to dilute their holding. Maybe the owners don't want to dilute their holding. So they may want to issue a non-voting shares.
But if they issue non-voting shares, it will still dilute the holding, because the non-voting just means the person won't have a say in the AGM voting stuff. So all those things are required. Should we vote for dividend? Should we vote to kick somebody out? Maybe control, I will accept, maybe not diluting their control. Mr. ID, let me also hear it from you.
Okay, thanks, Mike. But I think you just said what I wanted to say, and which is that because they want control, that's why they won't want to. That's the reason they won't want to. They will want non-voting shares so that they can have the control can be concentrated in the hands of some shareholders. That's the reason. Yeah, that's what I want to say.
Great. So can you think of a practical class?
A practical class, you mean like as you mentioned?
Practical scenario of which kind of people? Okay, you've tried. Let me not stress you too much. Sure. You've tried a lot.
Right.
So there's one common one. I don't know why nobody. Let me check. Mr. Tunde says CEO shares to topple you. I'm not sure I got that part very clearly. I'm looking at the chat box. Sorry, I have to turn my head. I have like 3 screens. Okay.
Hi, Mike.
Yes.
Yeah, okay, so I'll just give a practical example, right? Steve Jobs, when he was voted out of his first company, yeah, so, and his other companies, he was sure to limit, the voting rights. I think that's a practical example.
Great. Nice to see you. I didn't quite get it was you from the name until because I was like, the voice and I go, John. Thanks for joining.
Thank you.
Okay, so yes, And the common one, a very common one, is when you want to hire some people and you want them to join you. Like you have to sweeten the deal. So when you give them when you give your employees some equity, some stock in your company, right? Many owners of companies, they just want it to be as an additional compensation, not that now the employee will now block something or will be able to control decisions on a management level. So in that case, you probably want to have that class of shares that will not have any voting. So the employee is only going to benefit from the financial upside, but they cannot, it's not like you want to go and enter some deals. You now have to involve the employee again because the employee is a normal shareholder, equal right with you. So, all those things begin to, it blurs the line of employer, if that's not the case of what you want, if you just wanted the shares to be like extra, like, okay, this staff is proving too difficult to come, or they think we are too young, and you want to get somebody from like a Nestle or like a big company. And even though you've raised the pay, you've matched this pay, but the person is still feeling like your company is small, like I would rather go with a big company, or, all those things that come with when you're a startup and you're hiring and you're trying to get staff that are already working in a very established places. The only thing that you can give them that can, in fact, sometimes without you raising the pay a lot, if you just say, okay, sweeten it with the employee, with equity, you find out that they are much more willing to want to join you. But then, you might not want to give them control, like voting rights. So I think maybe that's also what Mr. Tunde is trying to say with the CEO shares topic. We even explained that Health Plus, what is happening with Health Plus. So that's a practical illustration of that one. Then number 3, redeemable shares. So not to take too much of our time, redeemable shares are now when you add, in addition to whatever is the normal wordings in most typical share, like for instance, now I'm working on a project and they decided to pay me or to compensate me. It's true, they decided to compensate me with some shares. The documentation, I read it, but I didn't read it too much because it was like 9 pages. I just skimmed through, went to the last part and signed. But then if I read through it, I won't be surprised if there is redemption clause there. Why? I'm doing a project for them. The owner of the company just is, let me say, is generous naturally, but also feels like he wants to compensate me more than the money is paying, right? So he wants me to have an upside in the project working out fine. So they gifted me, he worded it as a gift, but so from his own portion of shares, he gifted me some portion, right? And so let's talk about redeemable. So in that kind of a setting, also equally with the ones you give your staff, right? You might want to make a clause there that these shares, you as the company can redeem it at the nominal value if the staff leaves, within the next 1 or 2 years. So let's say if you leave in the next 24, if you don't stay 24 months, so if you're in the VC speak space, if you're in those startups, they call it vested, vesting and all. There are many words people use, but ordinarily it's the same thing, which is simply that we put a redemption clause. Okay, if you do not stay up until this length of time, we are going to redeem it at the nominal value, the whatever value it is, or we even redeem it at 0, which is why some people decide to use the word vested, which means you can't even claim it, becomes worthless to you if you do not stay that number of times, that vesting period. Okay. Anyway, all these are extra clauses, and it's not uncommon for you to have a class of share that will be both non-voting and redeemable, because that's what happens when you give shares to your staff. You don't want them to have control, then you don't want them to just suddenly resign the next month and still be able to claim that equity you've given them. So now let's go to preference shares. So for preference shares, you can see the list is long. Like I told you, I didn't even know that one can break it down to this number of lists until I started doing some research on this to at least do the theory part. The practical side is usually straightforward, because on the practical side, you just plug in the figures and it's nothing complex, at least for me. So let's talk about the preference shares. Preference shares are those shares that are like a hybrid of ordinary shares and fixed income. So what do I mean? Ordinary shares and bond. Let's say ordinary shares and bond. Why will somebody do a bond, or why will you? Fixed income is the better word. So let me explain. Fixed income is anything that you invest in, that like fixed deposit. Think about fixed deposit, that you are guaranteed, or you are told, let me not use the word guaranteed, you are made to expect a particular fixed income, fixed return every, let's say annually. In the US, most dividends are paid quarterly. In Nigeria will pay interim and final, or some will just pay you only once. But the key thing is, when you issue a preference shares, it's because you want the person to be able to gain from like a fixed income type of earning. So I'm measuring these 100 million naira worth of shares at a preference dividend rate. So we call it preference dividend rate of say 10%. So it means people buy into it, right? They will be expecting to get 10% of that 100 million naira. So let's say one person bought it. So every year he's going to be expecting 10% of the 100 million naira he put into it, right? So that would be like 10 million naira every year, which is similar to as if he bought into a bond of 10% yield or something that is fixed income. He did a fixed deposit of 10%, so like that. But then the thing about it also too, on like fixed deposits, you can't just suddenly go to the bank and say, give me back my money. So there are many clauses around, because you're an equity holder. So you see it gets that fixed income type of return. And there are some things about that will come to it. But on the other side too, you're an equity owner, which means you are supposed to share some of the risk. That's the meaning of equity owner. You're supposed to share some of the risk of company failing, company going up, both whether upside or downside. So what I want to get out for us practically is preference shares are still equity shares, but with additional clause of the company is committing to give you a preference dividend yield. We call it preference dividend yield. It can be 7%, it can be whatever percent. So which will be to you as if you are getting a fixed income, right? So that's number 2 of it. Number 3 of it is where most of all these things I'm going to talk about playing. What are the terms around it? So it typically has more possible terms than the ordinary shares. So let's start with number 1, cumulative preference shares. So cumulative preference shares is if the company does not pay, there can be reasons why the company is not able to pay you in a particular year. So for instance, I keep telling people, those who have come for my classes will have heard me say I tried buying into FinBank preference shares in 2008. Yeah, I think it was 2008. So FinBank was doing a public offer then, and there were 2 shares they were putting on the prospectus, same prospectus. So you could buy at 8 naira 50 kobo ordinary shares or 8 naira 50 kobo preference shares. I think the preference shares was at 7.something%, right? So that was my first exposure to preference. I started reading more about it. So the conditions for their own was this: that preference shares that was at 7 naira 50 kobo, right? 8 naira 50 kobo was the preference share, but dividend yield of 7.5, let's say 7.5%. So what that means is every year, FinBank, in quotes, is committing to giving all of us that bought into that preference shares 7.5% of our original purchase as our dividend. Okay, so while for ordinary shares, dividend is calculated against profits, for preference shares, dividend is calculated against your original investment. Let me repeat that. Ordinary shares, if you made a profit of, the company made a profit of 100 million naira, they can decide to give half of it as dividend to everybody, so the ordinary shareholder. But for preference shares, right, the dividend is always calculated against your original investment. And because in the terms of the preference shares, it's always put in there the percentage. So it's a matter of are we declaring dividend or not a matter of how much dividend are we declaring. Okay, so now back to cumulative preference shares. There are cases where the board might decide to not declare dividend in a particular year. Though it's a bad thing if the board keeps doing that, it's a very bad signal. But yes, that's part of the fiduciary power, the powers of the shareholders, the ordinary shareholder. They can decide that no, we are not declaring dividend. Okay, so anytime they do not declare dividend, right, especially for the preference guys, cumulative preference means that that dividend for that year will be carried over to the next year. So they do not forfeit their dividend. What it means is it can be cumulated. The years the company did not pay, these guys will claim it back in the future. Then non-cumulative preference shares. Non-cumulative preference shares means that when the company does not pay dividend that year, it's forfeited. You cannot, as a preference shareholder, you cannot claim it. You cannot have that money come back to you again. Okay, then participating preference shares. Participating preference shares. So in the next page, I'm going to show you how. So the VC things I get involved in, venture capital, angel investors, and all this term sheet stuff, right? They always, as an angel investor, as a VC, as a private equity firm, they always structure it as them coming in as a participating preference shares. So I'm going to explain why in the next slide, but I just wanted to bring out that. So participating preference shares means that you are going to have the same thing as regards, a dividend that has been already set at a particular percentage of your initial investment. You will have that, but on top of that, when the company is doing well too, and you can also benefit from additional dividends. So there are clauses around it. So the clauses could be that for every ordinary shares that is ordinary dividend that is paid, you're also going to get 50%. So there are always, the clauses could be tied to the dividend given to ordinary shareholder. The clauses could be tied to profit. That if you exceed a profit of this amount, then whatsoever dividend that is declared must also come to the preference guys. So what that means is that they will get their guaranteed dividend that is tied to the original investment. Then they will get also dividend that normally only ordinary shareholders will have gotten, dividends that are tied to the profit. So that's participating preference shares. It is the best of all the worlds, because you are going to be getting dividend that is like fixed income, then you still on top of it be getting the dividend that is like ordinary shares dividend. So I will tell us later in the next slide why venture capital. So when you are raising funds, be careful about how they word it, because you as the original shareholders, it's a lot of things you are giving up.
We are not seeing the slide. Is your picture we are seeing? Is you we are seeing?
Okay, let me go back to sharing the slides. Okay, so what about now? Is it back? Okay.
Yes, thank you.
All right, thank you for notifying me. Then I go to the non-participating preference shares. So non-participating preference shares, why all these things are broken down is not because that they are exclusive. They are broken down so that you will understand them naturally. So in a particular shareholding structure, you could have a preference share that is a combination of 4 of these, where you will say it's redeemable, where you will say it's non-cumulative, and where you will say it is convertible. So that one that Finbank issued in 2008, that was it. It was redeemable. No, it was not redeemable. It was convertible. So they gave a clause that after 5 years or so, we can convert it to the ordinary shares. Then it was non-participating and it was non-cumulative. So it had like 3 or 4 clauses together. What me are broken into different types here. So non-participating means you don't get anything above. Yeah. Hello, is somebody trying to? Sorry. So non-participating means that you are not going to get anything above whatever it is already put as dividend yield for you. Then convertible preference shares. Convertible means that you can convert from your preference shares to ordinary shares. So that Finbank one had that clause. They made it possible for us, I think after 5 years or so, that we can convert our preference shares to an ordinary share, so we can now be able to sell it on the stock market, because only ordinary shares you can sell in the stock market. So it means whatever when I get my share certificate, I cannot convert that preference share certificate into. There's a way you do the. If you get a share certificate, there's a way you get it registered to be tradable on the stock exchange, and all of that. Have it reflect in your CSCS if it was not. But essentially, you cannot trade a preference share on the stock market. That's just the way it is. It's only ordinary shares you can trade on the stock market. So they made it convertible for us so that after X number of years, you can trade your shares. The non-convertible means it's not a good thing. And it means you can't convert it. It's permanently a preference shares. Redeemable means that you are able to redeem it. So it's both ways. So it could be that the company can force a redemption. So you that are the company issuing the shares, could put a redemption clause that, after 4 years, we can force a redemption. There's a way they will put it legally, word it that it won't sound very bad, but that's what they are saying, that they can call that preference shares and convert it to an ordinary shares, or maybe redeem it at the prevailing something value, or like something that just makes it for them to be able to buy back, whether you want to sell it or not, because that's essentially what it does. Then some other time, it could be you that you are demanding. So if you are the one demanding for, you must be big. Either you are the person, you're a big angel investor, or relatively compared to the company you want to invest in, you are big. And so that's why we want to put a clause in there that you want to be able to redeem this at whatever you want, maybe at 3 times ordinary shares, at something that will favor you anyway. Then the guaranteed preference shares means whether the company makes a profit. What this one means is that the board cannot override your getting a dividend or not. So you are not, as a preference share holder on the guaranteed class, it means that your dividend is on the same level as loan. When a company borrows a loan, the board cannot be doing meeting and saying we are voting on whether to pay back the loan, pay the interest or not. No. In the clause of the loan, there is nothing that allows the board to be able to veto paying interest or not. If they try to do it, they will be breaching the contract of the loan, because in the loan terms you are supposed to pay the interest and the principal. So the same thing too, when you get a guaranteed preference share, it is baked into the share structure, that into the share clauses, that your dividend yield is guaranteed. It is not at the mercy of the board. Okay, they cannot have a annual general meeting and an AGM and decide that they want to not do a preference dividend that year. So that's I know it's a bit slow the way I try to explain it, because sometimes some of them are very similar. So I'm going to move to the next slide, where I'm going to talk about why angel investors and VCs and most of all these institutional investors, why they want to have a participating preference shares. But any question on this before I move to the next slide? Anyone has any question or any comment?
Yes, Michael.
Okay.
No,
yes.
I have a question. So I'm thinking now, your ordinary shares, right? Basically, what percentage, is normal? What percentage do you leave for a non-voting? must they always come, everything must be 100%, right? But what percentage do you leave for non-voting shares and, redeemable shares? I'm talking just basically about the ordinary shares right now.
Okay, so for the ordinary shares, before now, so in Nigeria, before now, you could authorize means in your book, you are creating in the company incorporation, in company setup stuff, you can authorize, say, 100 million shares. Okay, then you can decide to not issue all of that share. Okay, I can see someone's hand up. Okay, Victor, your hand is up. Is it relating to his question or is it a different question?
No, I have a different question. So maybe when you're done with him, then I can ask mine.
Oh, great. All right. So Nigeria, before now, right, as a company, ABC Limited, you incorporate and you authorize 100 million shares. That 100 million shares, you can decide that you want to issue just 70%. So you could decide that there are 4 of you, Mr. 1 or Mr. A, Mr. B, Mr. C, and you could decide that Mr. A will have 30%, Mr. B will have 20%, Mr. C will have 20%. Mr. Abolade, your hand is also up. Is it regarding this question or something else?
No, I just wanted to tell you to share the video recording and the slide with us after the meeting. So email it to us. Sir.
Oh, okay, noted, sir. Thanks. So you could issue less than what you authorized. So that on issued shares is now what, if you are bringing in employees or you are bringing in some people on board without you having to, there are different documents you fill with CSE. So when it is you are bringing in an additional investor without the existing investors having their own holdings readjusted, then it's seamless, it's simpler, it's easier. I think the forms you fill, the processes is cheaper and more straightforward than when it has to involve their original investors having their own, like you are going to take from their own to give to the new person, the new investor, the new equity person you are bringing in. So what companies used to do before now in Nigeria is they used to not issue out everything. So you could have like 20% that you have not issued out. Then you can easily add the form for adding additional investor is a lot more straightforward. And you don't need to start having difficult meetings with the existing shareholders because they are not losing you're not taking from their own to give to somebody else. But then in this finance act last year, they made it that no, you must always issue out everything you authorize. Okay, so that one now makes things a lot less flexible for companies now. Even they said if you have not issued out everything before, you must go and issue out everything now. So this was a very not so palatable things for. I have friends who that was the way they had done their own because they knew they were going to bring in some people or want to pay some people with equity. So that my answer that I just given now is which I'll still go back to what you're saying, but just to show that right now you must issue out everything when you are incorporating for the first time. So what that now means is if there were just 3 of you and you guys are going to have voting rights and it's just normal ordinary shares where you issued it out, then that's what will happen. Then if you're not going to give some shares to your staff or somebody that is consulting for you that you do not want them to have voting rights or redeemable share, they should not have voting rights. What will now have to happen is you will have to take out from maybe your own or take out from equal amounts from everybody's own and try to now give to that particular person. Okay, so as let me remember, your question was have I answered it? I think I've missed a part of the question.
Actually, you have answered it. Yeah, you have. I just have a follow-up, but I'll rather let others ask theirs. Yeah. Thank you very much.
All right, you're welcome. Mr. Victor.
Yes, thank you for your time and the class and everything that we've learned so far. I just have this question. I work in this company that does an EPSS, like an employee stock purchase plan.
Okay.
Right, employee stock purchase plan, ESPP. Yes. So you give them the approval to retain a percentage of your earnings, and then every 6 months they buy some shares for you from the company every 6 months, and then you get dividends as well. It's actually a very big company, and the dividends are as much as $1 per share every 4 months. You know, so
that's good.
But I've also realized that because at the time when I started it now opened my eyes to the American Stock Exchange. You know, I started learning new things. I became very interested in shares and all that. I started learning new things. And I realized that, okay, this company pays so well, and the share is actually very expensive, over $280 per share right now. You know, so what if I decide to sell all these shares and, you know, now buy some other companies that pay a lot more dividends? From my calculations, I could earn more than that $1 with that same amount. You understand what I mean? With that same amount, I can actually earn more than that $1 every 4 months from dividends. So I now attempted to sell them. Then I realized that these shares cannot just be sold. So it's with this explanation of ordinary shares and preferential, I'm beginning to realize that, okay, so what this actually means is that someone from the company is giving off a part of his shares to employees, and maybe he has the redemption rights as well. These shares cannot just take from him and sell them in the open market. I don't know if I am right. I'm trying to see if we can give a little more explanation around this whole scenario that I have painted now. Thank you.
Okay, so me too, I can only mention some of the things I've seen that around what you said. So Shell actually has something like this, and then what they do, and I'm guessing maybe it's pretty standard amongst these major IOCs. So what Shell does is they, you know, maybe somebody inside might know better than me, but at least from as an outsider, what I've seen is they allow employees to be able to buy up to a certain percentage of, I think maybe their annual income or something, up to a certain percentage of, let's say up to a certain percentage of their salary. You know, they are allowed to buy shares at a fixed rate, at a almost like, you know, if you are buying into rights. I don't know if you have seen where a company is doing a rights offer. You know, in a rights offer, they will write that this is the amount that they are going to, the right is being offered at. So take for instance,
yes, like UBA did it at some point or so.
Good. And that amount is usually less than the current market value at the time they are doing that rights offer. So that was the way they structured there, so that they let you know ahead the value that you're going to be able to buy at, and it's always less than the prevailing market value. So it could be, I can't remember whether theirs was as a percentage discount to the market or at the value that they are fixed from the start of the year, that you will now know, okay, throughout this financial year for Shell, you can buy their shares at this amount until maybe they set another price the next year. I don't know if it was a fixed price or that you can buy at 20% discount to the previous.
Yeah, it was discounted. It was discounted at about 15% or so.
Oh, good. So what I found out a bit from the way it was is, yes, there were some selling clauses, but I do not know the way it was structured. So that's the only thing I cannot answer. So the selling clause, maybe it will be that you have to. So usually what happens is all this type of buying, it's as if you are doing over-the-counter buying, because you are not buying on the stock exchange. You are not buying on an exchange. You are buying via a special arrangement that the company has made possible. So it's a bit like over-the-counter buying. And for you to be able to sell, it means you have to convert your over-the-counter purchase kind of. You have to make it available. You have to, like in Nigeria now, what that means is you have to tie it to a CH, your CSCS number. You have to regularize it in such a way that it becomes captured or on the stock exchange records too, and then it becomes sellable for you. So that's where the things can now be that I know about Nigeria, that what you have to do if you have a shares in any company and maybe you bought it before the companies went public, or you bought it via an over-the-counter arrangement, or you bought it in a kind of single transaction with somebody, you are a shareholder, let's exchange. I give you my land, you give me your shares, you transfer your shares to me. We did it in an arrangement that was not on the stock exchange, right? Then I have to, that arrangement now, I have to make it reflect in my own CSCS. Yes, the broker, the registrars will be involved, but the key thing is that for an arrangement that is involving, say, the company, they can decide to put some conditions before they will go ahead, before they will make the regularization happen, because that regularization has to be something that both me and you that gave me the shares have to do together a bit. So, Mr. Victor, is like you wanted to say something. So that's the thing that I know about.
I'm listening.
Okay, so that's where conditions can be on their own side. The conditions could be like they will never make that if it was a Nigerian company, and I know the process is just to have it reflect in your CSCS. They will say they will never do their own part of it that will make that your, that regularization in quotes for you to trade on the stock exchange happen until you meet some conditions. So that's the only way they can now delay you being able to sell, because or if that thing doesn't happen, you cannot be able to sell on the stock exchange. I don't know now for foreign listed companies what the process is like, but I'm sure it will be something like that to where they are just not going to let something that needs to happen until some conditions that they want to fulfill are fulfilled for you now to be able to trade it publicly on the exchange. I think somebody's hand was.
Thanks.
Okay. But that their own is doesn't affect the company structure, because the shares are not. It's not like you will now end up. They will not need to start filing another documentation for every single person that goes in through that route. So we used to they call it treasury shares. So if I open some companies, you will see they will write it in their equities, the number of treasury shares they have. So treasury shares are now like the shares that the company bought. That's what it means, kind of. They bought it, they can give it to anybody as they want. Or before it could be like retained it. But for most big companies, what they rather do is they buy it and not destroy it. So it's a very, I don't know too much about it because I've not been involved in those structures. I only know a bit from afar how companies mop up their shares so that maybe they feel that the shares are selling too low. So shares buyback. Apple does it every year. Microsoft too does it. And sometimes they might do it in such a way that the shares are not destroyed and can be given out. They are not completely destroyed and can be given out. So any other question on this part before I move to the next slide?
Yeah, Michael. Sorry, just one more question. You already painted the perfect scenario for the question I wanted to ask when you mentioned something about Shell giving its employee, some sort of shares. I want to know, those shares, are they from the Nigerian entity or from the main Shell itself? I just want to know. Right? For example, you have your company incorporated in the US as well as a Nigerian entity, right? Where do you issue these shares from, basically?
Okay, so like for me now, I have UrBizEdge incorporated in Nigeria, then also incorporated in Estonia. EU. So the EU tries to harmonize structures, so kind of like similar structures across all the, especially all the actual EU, not the UK and those ones that are not part of the Euro economic area zone, or like currency, same currency. So the key thing is on our side, right? It can be anyone. So it depends on which one is more, which one makes more sense. So if I'm dealing with someone in Nigeria, right, I want to give him some shares from our company, then it's more convenient to use the Nigerian registered entity, right? Then if it is someone we are dealing with outside of Africa, so someone in Europe or someone in America, it's a lot more convenient. In fact, the guy will even trust us more if we try to give him from the European entity than we say we want to give him from the Nigerian entity. So the only thing that it happens affect is on the book side. If the person is providing a service for the Nigerian subsidiary, for the Nigerian arm, and we are giving him, is a form of payment, is a form of, we're giving him from the European entity, right? Then they have to be, so our own companies are set up like sister companies. So they are not set up like one is the group, and the other one is subsidiary. They are set up as sister. Then there will have to be an interparty, like is usually called intercompany or interparty, where intercompany transactions that will capture that. So one has to read the laws too, because sometimes it might end up now, that's what people call shell company. When you have a company that is not doing any transaction, but you are using it to move money via equity or shares, all of that too. So to break the law can be easy too, but it's possible if you read the law and you ensure that the country you are doing this, like Estonia, we read and see that this is not going to look like we are doing money laundering. Okay, but it's possible that, yes, your question is always the one that is more convenient to choose. And the one that is tricky is if the person is providing service to the other one and you want to now give him shares in the one that is not the one he's providing service to, the lines can start getting blurred between what is actual malpractice, money laundering, or evasion, money laundering plus tax evasion plus many things bundled together. But usually you can pick anyone. You can, whichever both of you find is more convenient.
Okay, thanks a lot. That's very clear. Thank you so much, Michael.
All right, so I'm going to move to the next slide. I think there's no more questions on this part. So the next slide is, VCs, do VCs and angel investors ask for preference shares? From my own knowledge, yes. So this is more of why. So I was trying to find out, I wanted to tell you why, but I wanted to research more on the why. Okay, the why that I know, is that the global why, or are there some other reasons why this is done? And guess what? I found an answer that was just so perfect. I decided to screenshot it and share it with us. So I'll first tell you my own why from my own experience. So many of you will have read it, but I have to say it as a disclaimer so that it doesn't look like I'm saying something and you are not knowing on the basis. So I work part-time for a private equity firm that invests in Francophone West African companies, and I do financial due diligence. So most of the structure, financing structure, we usually consider three ways. One is loan. So loan is, there are so many things that are like gray area. So I'll give you an example. Maybe the company has not been paying tax, right? The company have some regulatory or incorporative problems that if we want to invest in that company, we cannot invest in it with the kind of things that are maybe structure of the company, or especially if you're investing in agricultural firms or companies that have been existing for long and they are not in all these tech areas. You find out many farmers, many agri companies, they don't do all these tax and all. Why? There's nothing that forces them to do that. You plant, you take your produce, you go and sell in the farm. The farmer you are selling, when you go to market to go and buy, do you ask the person you are buying from, what's your VAT number? What's your company registration number? You don't ask them, right? So that happens a lot for people who just sell directly to customers that do not now need to be. But for me, no matter how small our own business is, right from day one, we had to get tax and all of those things, because when a company wants to do corporate training, get our service, they start asking for all those vendor registration and all those things. So for us, it was a lot more mandatory. But for some people, all the guys in Alaba's market that are doing 100 times my volume, 100 times our own volume of transactions, they don't have some of all these things. Why? The customers they deal with don't need it, and it's like unnecessary headache for them. So if you now want to invest in those kind of company, you'll find out that you cannot invest in them in the structure they are, otherwise you will inherit all those problems. So if you see a big opportunity, you really want to invest in them and maybe start making a case for why things have to be done properly, and then you need to incorporate. You might want to first start as a loan that is now structured in a much more beneficial way. Beneficial in terms of you might not be asking for what banks will be asking for, because you might even now start being on the board or put yourself as a management consultant that you'll be getting some management fee. You can structure it anyway, because that's the good thing. But the money you are putting in is coming as loan. So there is that one. There is a second option of that problem is not there. So you can actually invest as an equity person in the firm. But that business is a very volatile business. They do not have maybe any, take for instance, you're investing in a retail company, you're investing in something that is like competition to ShopRite and Spar and all. That business, there is no, unlike you are doing Coke, you can say your own Coke is different from Pepsi, is different from Big Cola, right? And you can decide to price things differently. In that kind of a business, you don't have pricing power, because everybody who goes to buy will buy from the person that sells to them at the cheapest. The only thing you can do is you can say you have parking space. But parking space is not enough reason for you to say you want to sell your own produce at a higher price. It can just be enough reason for somebody to go from far, like, instead of you just selling to people close by, people can come from far and say because you have parking space, So you don't have pricing power. Let me just use that word. So for that kind of a business, they are usually slim margins, and any inefficiency on the part of the business owner becomes a problem for you as an investor, because inefficiency means they'll be spending more on operating expenses, or they'll be having some expenses that you will now not have any money left as profit attributable to owners of company, right? So for that kind of ones, sometimes you might want to structure the investment as a kind of a revenue, like a royalty kind of stuff, where you are pulling the money out as against revenue. I'll give you an example of stuff that are like that. Domino's, even Coca-Cola in Nigeria, even Nigerian beers, Heineken, right? They get something like a royalty, where for every Coke bottle that is sold, for every Domino's pizza, for every Heineken that is sold, not about profit now, for that sales amount, there's a percentage that we just go back to maybe Heineken Amsterdam, go back to Coca-Cola USA, go back to Domino's USA. So that's the approach. But now you as a venture capitalist, as a private equity, you can decide to also take that kind of approach. There's nothing that says you can't take that kind of approach, where you provide technical and they are able to access your ecosystem. You provide a lot of things to support the business, to grow it. That's why VC is different from bank when they give you money, because it's not just money, they're giving you a lot more other things, right? And then, but that money you're pumping in, you don't want to pump in as equity yet. Or you pump in as a hybrid, some percentage as equity, some percentage as that one where you are going to take it as a revenue based, where they have to pay you from revenue anyway. It's a very funny kind of structuring, but it's also possible. And then there's the third one where you're just pumping it as equity, and then preference shares. Whenever it's equity, they like to pump it in as preference shares. So that is what I know before now, right? That they always have to think of it in that way. Preference shares means that it's not until you exit, because when you invest in a company as an ordinary shares, then it's either the company goes on stock exchange before you get your money out. Your money is locked in. The only thing you can get is dividend, which startups don't pay dividend. A company that is growing, you will not even want it to pay dividends. Better they use the money to expand, right, rather than be paying dividend, right? So you just see that you won't get a way out unless you're able to go and do some over-the-counter. You get somebody you can transfer your ownership to, and the person is willing to pay you at some much higher money. It's very rare. Okay, so what you can now do is you can decide that I'm going to put in my money as preference share, so that every year I know I'm getting some fixed income. So if you put in your money at 10% preference dividend yield, in 10 years you'll have gotten your money out, because that's what 10% means. You're getting 10% every year. 10% times 10, that's 100%. You've got 100% of your money back already. Then some other things they try to do is, if you are doing it in Nigeria, you might want to invest in USD. You don't want to invest in local currency, so that we all know why. So you will now invest in it, even though the company is doing business in Nigeria. You're in Nigeria and you have naira. You would rather go and convert your naira to dollars and now invest in that denomination in the company, so that when they are paying you all those things, you're getting it back in the dollars worth of money. So now let's look at what he explained. So he did a much more thorough explanation. So he said that before, they don't used to, that many years or decades ago, people, angel investors, VCs were okay with coming in as if they are just the normal companies. You just go and add them without you changing their class of shares. Okay, so they are pari passu with the founders. Remember what I told you, founders will definitely start as normal ordinary shares, because that's the one that is recognized when you are incorporating a company. So, but then they said there have been cases, so if you see, but in a couple of cases, founders have needed to close down business. So what that means is the founder, let me tell you, if you are the founder of a business and you are the MD, which we call owner manager, you are collecting salary. So, you go and benchmark. That's what you do. You go and benchmark against, okay, in the industry, what do they pay? So you see someone who is maybe 26 years old, right? But because he found the company, right? And the company is growing big because investors pumping money, right? So he needs to hire head of technical CTO. He goes and hire a CTO that used to work in maybe Oracle, or used to work in Cisco, or work in Microsoft. He has to pay the going rate. So when he does that, you find out that he, as the MD, ordinarily should not be getting less than the CTO, right? So what happens? They need to regularize their pay structure. So they hire an HR person who will go and do research and say, this is the pay structure for your industry. Then he, as MD, start getting a very high pay salary. A salary that if investors' money did not come in, right? I don't know, Sky is making noise. I hope it's not. Sorry for that. Okay, so as the owner and manager, like owner CEO, you're already getting money back, because you are getting a salary that ordinarily, if you are not the owner of the company, at their age of 26, there's no way anybody will be paying that kind of salary. But because you are the CEO and they've regularized your pay structure, you're already getting money. So the owner is not making a loss. The founders, because they are involved, they are getting salary. But you that you're an investor, you're not getting salary as an investor. So it's your money that is being used to make salary for him. So now the company now folds up. When the company folds up, because your equity are on the same level, they will share it. So maybe when they liquidate the company, maybe you invested 50 million naira right? When they liquidated the company was now 20 million naira, and that was what they could get off from the thing. By the time you guys decide this will not work and you have to sell off, because that's like what happened with Conga. They had to sell. They felt this is not going to work anymore, and then it was sold to Zynos, right? So if they sold it at much less, what will have been able to settle everybody, right? What that meant before was that everybody, so maybe the way they have done is 60% to you, the founder, 40% to those investors. Now they sold it for 20 million naira. They will still be sharing that 20 million naira. So the investor will be getting 8 million, you'll be getting 12 million. So you have not made any loss whatsoever. You have collected bumper salary that you never will have gotten if investors are not coming, and then you have expanded and you are using the investors' money to pay salary, right? And you have paid yourself too, okay? And then when they are liquidating again too, you are still getting the lion's share. Why? Because you have 60% shares, right? So they started not wanting that anymore. They decided to now start doing preference share. What preference share means is you pay them first before. So they put in 50 million naira, they liquidated at 20 million. Then you won't get anything, because even the 20 million naira could not offset their own 50 million naira, right? So it made sense for them, which if you even think, or it makes sense actually. Forget that you are the founder. It actually makes sense, because the truth is that you must have been getting a lot in salaries, in compensation, that would not have been possible if you had bootstrapped and you did not need to start making your salary scale or pari passu with the industry salary scale. So let's continue from there. So that was where now that's but in a couple of cases, the founders would fold the company and distribute the remaining funds. The founders ended up taking some of the angels' money, some of the investors' money. I've explained that. So there's no downside for them. It just means if you start a company, there's no downside to you just getting an investor. Why? Because you will always make money even if the company fails. So the angels started wanting to have non-participating preference share. So what is non-participating preference share? The one where you just preference shares. If you declare dividends, to ordinary shares, they will not get anything above their normal preference dividend. Okay, so this was just so that when there is any liquidation or anything, their own money comes out first before anybody starts thinking of your own, you the founders, because founders are always ordinary shares. Nothing else like that. So that's that paragraph 2. But then when venture capitalists and everybody started, that's the thing now. Everybody will always, what can I do to be better? What can I do to get more? Everybody wants more, right? So they started preferring to structure it as fully participating, so that yes, they'll get their money first, they will get the preference dividend too, but if the company grows really big, because it's their own money, the company used to grow really big, then they too should benefit from that equity growth. That's what we call participating. Whatever dividends that is being issued based on income, based on profit, they should also be able to benefit from it. So that's the current state where everything is now. And this guy helped to show the transitioning. So I think that's the end of today's session. I won't be able to do the practical. This is the end of I was before planning to go and do the Excel, where we go through how, sorry, if I go and show you another client's work. So, but any questions from this? This is where we end today. Any questions before I close the session? And thanks a lot for joining. Today has been a unique one in terms of it was more of talk. But like I said, I wanted to be sure that I have enough for 1 hour than have few for 1 hour. So no questions, right? I can end the session, or anybody has a question in mind, or contribution. Necessarily doesn't have to be a question. It could be a contribution. You have an idea, or you've seen something you want to share with the house. So while that is happening, at least I can share the slide. Oh, there's something I should not show on this mine. There's a client work. I forgot to shut it down before doing the webinar. I don't want it to show when I close this. So I'm going to close this. Good, it's not showing. So I'm going to upload this on on what will make it possible for me to share with us. So I'll share it with us. And as for the video, you all know that the video is always going to be on YouTube, like one day after. Let me show us the link. So the video is going to be on YouTube. Let me quickly give us the YouTube link. So the videos will be here. By tomorrow anyway. Then let me give us a slide. So the slides. My pleasure, Monsieur Anthony. Thanks. So I'm trying to upload the slide. Sorry, if I had known, I would have opened this earlier on so that it will be faster. So I have it as officer line 52. So almost done. It's uploading. It's uploading. I think it's done. So let me just refresh. Arrange by last date. Get the link. Paste on the chat. So the slides. Great. So I've given us a slide now. So thank you very, very much. And I hope to see us next week. For Excel, let me quickly just give you, we have Excel happening in about 1 hour's time or 50 minutes time. So let me give you the link. And then we have Power BI happening by 6 p.m. So I'll quickly just give us the link. So for Excel, if you're interested in Excel session by 4 p.m. by 4 p.m. And if you are interested in Power BI by 6 p.m.
Michael.
Yes, sir.
Frank, good afternoon.
Hey, okay, Frank.
It's been a while.
Yes, it has.
I was in Lagos last week where I tried reaching your office, but a bit tight. My phone is off right now. I can't get, can you just, okay. I don't know how to get the link for the Excel class.
Okay, I will get it across to you. If I send it to you via WhatsApp, you will see it, right?
My phone is off. Maybe if you mail it, I can get it. If you mail it to me.
Yeah, I'll mail it to you then. So thank you, everyone, and I have to end the session now. Bye.
Sorry, Michael. Is there a way one can use Power BI as an individual without using an organization's account? Like I'm interested in learning Power BI. I want to learn, but every time I try to install it or set it up, it tells me to impute some credentials that have to belong to an organization. Is there any way for individual users? You know, okay. Like single users.
Okay, great. So I want to show you. So this is what you are saying. If you go to start free.
Yeah.
If you go here, it will ask you to. I need to log out from my own account so you see the way it's like. Let me use a browser. Let me use a browser that I do not have any.
You can use a different browser that you don't log into. Yeah.
Let me try file. Power BI. Why is it taking time like this? It's not as logged me in, I'll log out. At least this one I'm okay with logging out on this account. That one, if I log out there, Teams and a whole lot of things will log out. So I just patiently wait until I need to tell me. Oh, perfect. I'm going to log out. This is another project account. Let me go to office.com and log out from there. Log out. Okay. So now let me try. I need to go to this one. How can I tell it I'm not interested in signing with another person? Use a different account. Great. Next. Let me see if I can do incognito or something. New private window. Let's try that one. Finally. So if you go to Power BI, so regardless of how it shows, it will always be something where you sign in, try free. If you go to try free, because that's a common thing that you normally would want to click, like, okay, I want to try it, I want to use it, I don't. So this is where you are saying, if you put a Yahoo or Gmail or Hotmail, if I put, so I put, I have a Gmail account. So if I put a Gmail account, it's going to complain. See, it says enter, this looks like a personal email address, enter a company email address. Okay.
Exactly, that's what it usually says.
So there are two solutions, or two things, let's call it solution, because one is not a solution, one is a solution. The thing is, to use Power BI, it's not compulsory you have an account. To use Power BI, you can go and download the Power BI app. So if I scroll down, you see download section. It's always at the bottom. You see this download section. Just click on download Power BI desktop. So when I'm here now, I'll say download free. This one is not going to ask you to log in. You can see it didn't ask me, do I want to log in? Do I want to create an account? It's not going to ask you that because this is not tied to any login. So to want to download it for you free as store, if you don't have a store, if you have not activated store in your computer, no problem. See other download options. This one, this see download options. Click on it. It will take you to where you can download it, in a normal way. So most people's computer will be 64 bits. So pick the 64 bits. Say next. Then it will start downloading as a normal, normal download file. I click download. Say start. It should be downloading by now. Yeah, it's already downloading. So this is not going to ask you for any login credential, okay? When you download, it's like I have another company's. Let me open an empty one. I used to forget to close all the work I'm working on. So I'm trying to open an empty. You will see that once you download and install, you'll be able to have Power BI on your. It's opening. Then you can work. You can create reports, create anything. It's not going to restrict you to, you don't need to log in. Once it comes up, I'll show you, and it's coming up. When you install, this thing that I'm downloading, when it's done downloading, and I click install, this is what it will install. And this is the Power BI itself. This is if you ask me, this is the actual Power BI. This is it. So what will just be different is that in your own case, in my own now that I have a login account, your own will not have a, I'm going to log out, sign out. So your own will not have a sign in. It will just be as if you can't, and you won't be able to sign it because you don't have work email that you want to attach to it. So this is usually what I tell people, that do this first, at least use this one, build the report, build whatever you want to do. Then now that's why I say this one is not a solution actually. Now the solution, the second thing that can be a solution to, maybe you want to publish the report, and at that stage you actually need to have an account, because it's going to tell you to put the account email. So what I now can tell you to do, which is what I have, is, where is that incognito again? Is that incognito? I think it's this one. So here where it's asking for email, right? Many email providers sell email. In fact, you can get email for like $4 per year. Is that cheap? And $4 is nothing now. $4 per year is really, really small money. Me, the one I did before is $10 per year from Google, but Google has stopped it. So Google does not do that one anymore. But you can get an email. Just say, get a cheap email, cheap custom email, because that's what it needs, custom email. Doesn't mean that you have to be a company. What they just want is, as long as the email address is not Yahoo or Gmail or. So I don't know anyone off the top of my head when I'm Googling, but I know that the prices are very cheap. So if I go to any website, this one now says I can get email. See, this is really cheap now. I can get email for $1 per month. I mean, this one is per month. Yeah, so it's per month, because this is what I'm paying on Google now per month. But you don't need that. Me, I'm needing it in Google because, okay, there are some other things, Google Meet, Google Sheets, Google many things that come with it. But once you just need email only, then you don't need to. You can do any cheap one. You know, these guys are also good. This is Ionos, so you can use Ionos. There is a company I'm with. There is Ionos they are using, and it's very good. And it's just $1 per month. But I know there are some that are cheaper. This one is cheaper. If you really look, you'll find a lot cheaper ones that you pay maybe like 50 cents per month, which is like $6 per year. Then buy it, that's all. So once you have that, just go back here and put that email here. And that's it. And it's an email. You can even decide to pick an email that you like. So that was what I did. Originally, my own email is michael@olafusimichael.com. It's like personal branding. So it's like, you know, it's my name, especially those of you that your names, you can't find it again on all these Yahoo and Gmail. So, you know, it makes it look, some people used to say use they're like michael@i.com. You know, there used to be these other people that used to provide, and they will say tunde@me.com. If you can buy from those ones too, yes, those ones will charge you more because they know that it looks very fashionable, something at me.com. So those ones might charge you maybe $20 a year or $12 a year. But in that case, it might even be worth it, such that you will now have a proper email that is your own name. You know, it's not something at gmail.com. Then you have to put numbers in front of it because the one you want is already taken. So that's what I did originally, and that's like a solution to cost you money. But if you are okay with $6 a year, I'm sure you will get an email at $6 a year. Google,
Okay.
Yahoo used to do one that is very cheap, that is like that $6 or $4. So if you do Yahoo custom email, so what they do is they will give you a custom email address that will be forwarding to your normal Yahoo email address. So there was a time I tried doing that one, but I didn't do it because I wanted something more. But that one was really cheap. All you just do is get your name, professional email address. So it will be redirecting to your normal Yahoo email, right? And blah blah. So this one I think is also cheap. I don't know the current price, but that time, like 7 years ago when I tried, it was very cheap. That I almost did it, but I now went for Google because Google gave me some more options. But Google was more expensive. So that's the one I would say is the real solution. So at least you will have the account. When you are done with the report you are creating in Power BI, you can be able to publish, and you won't have problem. So thank you very much then. So let me wave us bye-bye and end the session. So okay, goodbye. Ending the session now.